Welcome to the Lane Gorman Trubitt Summer Survival webinar series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the summer. Changes to legislature, tax policy, and a business environment that is constantly in flux can make it difficult to keep your head above water. Lane Gorman Trubitt Tax Department presents Qualified Improvement Property, a hidden perk in the CARES Act. This webinar will teach you how the CARES Act retroactively fixed the Qualified Improvement Property drafting error from previous legislation. Learn about the changes and how to correct previous tax returns. It was recorded live as a Zoom webinar on August 12, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com.
I'm happy to present today's speaker, Corey Cadell, a CPA at our firm. He has extensive experience training and supervising staff, as well as teaching in-house CPA courses with the real estate and tax environments. Some of his current responsibilities include the preparation and review of individual, corporate, and partnership income tax returns, as well as state income and franchise tax returns. Corey also serves as a liaison between partner, client, and professional staff on tax engagements. Well, without further ado, Corey Cadell.
All right. Hello, everyone. I've been with the firm for a little over a decade now, and I'm a senior manager. And as Katie said, I've worked primarily in real estate industry. So let's see here. Just want to forewarn you, I'm used to giving presentations, but this is my first webinar I've given, so we'll see if I can get these controls right. I feel confident. I think I can do it, but we'll see. And I also want to warn, I have a 2-month-old in the house. I'm a new parent, but hopefully it'll be quiet while I'm giving this presentation. So without further ado, let's talk about qualified improvement property. We're gonna talk about, what is qualified improvement property. We're kind of talk about the pickle taxpayers were in before the CARES Act. We're going to talk about how the CARES Act helped out the real estate industry. And we're also going to discuss how qualified improvement property and bonus depreciation kind of interacts with other aspects of the tax law. My goal is to keep this kind of high level. I don't want to get too much into the weeds. I know whenever I go through or watch presentations and do research, if there's a lot of code section references and whatnot, my eyes tend to glaze over. So I tried to keep that at a minimum here. So we'll see how I didn't fully succeed. So, but we'll see how we do. So let's get started here. All right. And so before we kind of move on to what qualified improvement is, I kind of want to talk about the old law before the Tax Cuts and Jobs Act was enacted. And so before there was just qualified improvement property, there were 3 types of property that kind of made this up. And this is qualified leasehold improvement property, restaurant property, and qualified retail improvement property. And this all applies to assets that were placed in service before 12/31/2017. And these all got the class life of 15 years for depreciation, which is a big deal, as we'll see later on in the presentation. That class life allows the qualified improvements to be eligible for bonus depreciation. And basically, just in a nutshell, all these are pretty much just interior building improvements. They're generally for the benefit of a tenant, and it's usually, some examples of it is just light, electrical, plumbing, light fixtures, heating equipment, etc., ceilings, doors, and it's usually for the landlord to either woo a tenant into the property or keep one there. But anyways, what it's not, the old law was a bit more restrictive. And so there was a requirement, there was a 3-year requirement. So buildings placed in service had to be placed in service for 3 years before an improvement could be considered a qualified improvement or one of these leasehold improvements for restaurant properties or retail improvement properties. And also in the old law, the improvement couldn't benefit a common area. So stairways, hallways, lobbies, common seating areas, all that, none of that was allowed to be improvement property. I keep saying qualified improvement property, but you know, these 3 terms here. Let's move on to the new law. And so in 2018 is when the Tax Cuts and Jobs Act kind of went into effect. And so in that, those 3 terms, they did away with those 3 terms. They combined them and simplified it and made it qualified improvement property. And just like the others, it's any improvement to the interior portion of the building. And it's after, it has to be after placed in service after the date the building was placed in service. I didn't mention this in the earlier slide, but this is, we're talking about non-residential real property. So it's pretty much commercial property. And like I said, examples of qualified improvement property is replacement of drywall, ceiling, interior doors, electrical, plumbing, and stuff like that. What's excluded from qualified improvement property is building enlargements, elevators or escalators, or the building, if any improvements to the building internal structure or framework. So load-bearing walls, columns, beams, if any of those, any improvements to those don't get to be called qualified improvement properties. They're just regular building improvements. The new laws, it's more broad, so it gets rid of the common area exclusion, and it gets rid of the 3-year requirement. But there's a little bit more nuance that just keep in mind that the improvement has to be placed in service after the building is placed in service. So if you're constructing a new building and you have tenant finish outs for your tenants coming in, those unfortunately won't be able to be qualified as qualified improvement property. It'll just be part of the overall building cost. It's after the building is placed in service. Or if you're purchasing a building, if the prior owner did have tenant improvements, you don't get to count those. All those get lumped in and just to the building. So they don't get the 15-year property designation. And I just kind of threw this in here just so, you know, we can have just an idea. I think we could do a whole presentation on what's a capital expenditure and what's a repair. But I just want to throw this just the kind of basic term just so everyone's aware. As a capital expenditure is an expenditure that makes the property more valuable, makes it more useful, makes it longer lived. Any kind of improvement such as that is going to be capitalized and depreciated. If it's for, you know, if it's a routine maintenance, if it's to make the property more efficient, or efficient operating condition, or to store it to its original use, then it can be repaired or expensed. And just get a little more in the weeds, I want to throw in what the de minimis election is. It's you can expense up to anything over $2,500. So we're just looking at larger repairs or capital expenditures. Let's see, what else? Oh, so also want to give some examples of what's not qualified improvement property. Like I said, it's in the interior portion of the building. So anything on the exterior, it's not going to count. HVAC, rooftop units, that's a good one. Our clients typically kind of throw in that leasehold improvement area, but it's really a building improvement. It's going to be a 39-year property. It won't be included in qualified improvement property. Anything exterior electrical, exterior painting, rooftop improvements, even if it's over the tenant space, that doesn't count. Site utilities, windows, exterior doors, such as that. None of that counts as qualified improvement property. And then so, you know, the new tax law, they drafted the new tax law, they simplified it, they got rid of those old terms, made it one term, made the definition a little bit more broader. And it was intended to keep that 15-year life. But as you will see in the next slide, there was a bit of a blunder when it came to executing, putting the law into, or drafting the law. The qualified improvement property was intended to be 15-year property. So it was intended to, you know, incentivize property owners to invest capital, to have improvement projects. It's supposed to get that 100% bonus depreciation. Well, bonus depreciation, it changes, the percentage changes every year, but as of right now and last year, it was 100%. But due to some technical error, they didn't amend a certain portion of the code. And so as a result, qualified improvement property was treated as 39-year property. And even though it was clearly an error and it wasn't the intent, and it was well known, the IRS took the position that that the property has to be, they have to follow what's written. And so the qualified improvement property was 39-year property. And the only way to change it was through a technical correction. And I remember learning about the new tax law late 2018, and this was a big deal. And you know, we're just shocked that such an error, such a big error, could happen, as with a lot of people. But so just kind of give you a time frame of where we were before the CARES Act was passed. You know, this was a clear, obvious error. There was a lot of talk in December of 2018 that they were going to fix it, that they were going to, you know, just make a quick correction, pass it through Congress, easy peasy. But then I don't know if you remember, the government shut down, and then that threw a whole wrench into everything. The technical correction didn't get passed. I still remember last year's filing season, early 2019. And even into the summer, we were sure that Congress would pass the correction, given how significant it is, significant the error is, but we still didn't get it. And so we got into late 2019, early 2020. I remember going to all this continuing education classes, learning about the next filing year, and a lot of people were under the impression that qualified improvement property, the technical correction would never get passed. And so as a result, there's other aspects of the law that kind of is intertwined with this, and there's some planning opportunities. And a big part of the qualified improvement property is the bonus depreciation. And if you weren't going to get bonus depreciation, then the business interest expense rules, there were some, well, we'll get into the next one. Yeah, this is we're taking a little side tour here, but the bonus depreciation, the large deductions, that kind of is intertwined with these business interest expense rules, or the two are affected by each other. And so we could have a whole nother presentation over these business interest expense rules. I think it's the most complicated part of the new tax law, especially when you're dealing with flow-through entities. But in a nutshell, it's generally, if you have business interest expense, if you're a trader business, your business interest expense is any part of it that's 30% over your adjusted taxable income, and your business interest income is disallowed. And if you're a leveraged taxpayer, as many commercial rental properties are, you can be greatly affected by this. You can have some serious limitations to your business interest expense. And so a way to get out of these rules, and a way to to not have to worry about them at all is you can elect to be a accepted trade or real estate trade or business, and making that election forces you to switch to a depreciation method that has longer class life for the assets, but also doesn't let you take bonus depreciation on certain assets. And so this is kind of the discussion point, is whether or not to choose, if you're greatly affected by the business interest expense rules, and you're trying to decide if you want to circumvent these rules, you have to decide if you want to get rid of bonus depreciation. Well, back before the CARES Act, it was looking pretty glim for if the technical correction would ever get passed. So a lot of taxpayers started having conversations about it was a no-brainer to elect out of these rules. If we weren't going to get bonus depreciation anyways, or it's very unlikely that we were, might as well free up that interest expense now. And so, and just a little bit more on the business interest expense rules. I said that I have this 30% on here. The CARES Act adjusted that amount to 50%, which I'll go over a little bit later. But the taxpayers affected by this are, a taxpayer who has a trade or business that's over, I forget, the gross receipts test is, I think it's 26 million this year. It's around that, plus or minus $1 million. Or if you don't have gross receipts, you're a small business taxpayer, you aren't affected by it, but however, you can't be a tax shelter. And according to the rules, tax shelters are limited partnerships that allocate more than, I want to say 35% of losses to limited partners. So it's a lot of pass-through entities, even though their gross receipts aren't over the threshold. If you have a loss 1 year, it'll throw you into a tax shelter 1 year, and you have to deal with these rules. And I'll kind of show how business interest expense kind of correlates with the bonus depreciation later on. But okay, so let's go to the next one. And yeah, this is kind of what I said. Technical correction seemed very unlikely. So I had many conversations about just electing out of the rules altogether, since we weren't going to get bonus depreciation. And it's a big deal because that election is irrevocable. So once you go, you generally, and I'm foreshadowing there a little bit, you generally can't get out of it once the election's made. But anyway, so let's go to the current events, current timeline. Let's see here. All right, so it took a pandemic to kind of seize the world to get this technical correction passed. In April 2020, Congress passed the Coronavirus Aid, Relief, and Economic Securities Act, and is used to combat the economic effects of COVID-19. There were many beneficial changes to the TCJA to help out taxpayers. And what was slipped in there, surprisingly, was the technical correction we had been waiting for. And like I said in the earlier slides, they changed the business interest expense limitation from 30% to 50% for most taxpayers. And then partnerships, they don't get any benefit this year, but next year they get the 50% increase, and they get to deduct, no questions asked, 50% of any previously disallowed business interest rates in 2019. And so the technical correction that was included in the CARES Act, it gets retroactive treatment, meaning we're in 2019, but the 2018 qualified improved property also gets to be considered 15-year property. It's eligible for bonus depreciation. And it's eligible in 2018, 2019, it's 100% bonus depreciation. Also included in there was the options for taxpayers to elect out of bonus depreciation, or if they previously already made the election, you can revoke or withdraw that election. And as I foreshadowed earlier, this also applies to certain taxpayers affected by the business interest expense rules. I think that's, yeah, so let's go to this next one. All right, and I know I said I wasn't gonna put much code section in there, so I apologize, there's a lot in here. But I just wanna kind of throw this in here just so you're aware of it. And it'll kind of go into what I'm talking about later, but as I said, taxpayers, in addition to the qualified improvement property and the business expense, there are some RevProcs that came out that also allowed you to revoke or withdraw elections that either had been made, or you can make a late elections regarding bonus depreciation and alternative depreciation system. And so these are just the code sections that apply. The first one is ADS is, if you elect out of the business interest expense rules, you have to use ADS, and that's what doesn't allow you to use bonus depreciation on certain property. I've never heard of this second one, but I threw it on there because I thought it sounded kind of cool. It has something to do with plants. So just in case we have anybody out there that you can use this, it's there. But these last two are, I've seen, if you want to make a late election to elect out of bonus, or if you want to make an election to use 50% instead of 100% bonus depreciation, you can either make a late election, or if you already made that election, you can go back and revoke or withdraw that election. And, you know, I just spent the past few slides talking about how we wanted, how we needed the 100% bonus depreciation for quality improvement properties. So why would you want to elect out of bonus depreciation, or why would you want to elect to elect out of 50% bonus depreciation? And it's all about options, and it kind of depends on each taxpayer situation. But the bonus depreciation kind of affects other aspects of the law. So kind of as I mentioned earlier, partnerships that have losses and allocate at least 35%, over 35% of those losses to limited partners, which is a lot of partnerships, then they're considered tax shelters, and they're subject to the business interest expense rules. So one reason why you would want to, you know, take the 50% bonus over 100% bonus is you want a deduction, but if you can work it to where you don't have a loss for the year, you also don't have to deal with the business interest expense rules. There's also some QBI implications to deal with that. So I just kind of threw this on there just because it was added to all this to give taxpayers options, allow for some tax planning opportunities. And so as far as the business interest expense rules, this is kind of redundant, but as I said, it was irrevocable, but they made an exception for, they issued out a RevProc to kind of provide relief for taxpayers who made the election thinking a technical correction would never be passed and they weren't going to get bonus depreciation anyways. And yeah, so this applies for the 2018, 2019, 2020 years. And also, you can also make a late election to elect out of the business interest expense rules if you want. And so there's a whole RevProc going through the guidance of how to do that. And then, yeah, so let's go to the next one. All right, and so, yeah, as there are a few options on figuring out how to get the deduction, what's the best best way to go about it, which year should you apply it to. There's kind of three options that we can use. So we can amend tax returns for taxpayers, including partnerships. They can file amended returns, and we can do this to change from going from the 39-year qualified approved property to 15-year qualified approved property. To IRS, it's considered going from an impermissible method to a permissible method. And so it applies to, if you want to make the change in depreciation for qualified approved property, you can amend returns. And if you want to make late elections or revoke or withdraw elections regarding those bonus depreciation we had on the other side, we can do that. And so this applies, for the 2018, 2019, 2020 tax years. There was a RevProc that came out that allows us to do that. That RevProc, it doesn't cover the business interest expense rules. And so the process is a little bit different, but to get out of those rules, you're still going to amend a return, but you're going to add some statements in the back of your return, and you're going to make adjustments to taxable income. And so it says inapplicable, but it's different. It's a different way to do it. And I just want to note, I kind of singled out partnerships here for a reason. And I'm trying not to go into this too much, but partnerships, I think it was 2 years ago. Anyways, there's what's called the central partnership central audit regime. It's very ominous sounding, but we're going to call these BBA partnerships. And what that did is it made it a pain for partnerships to amend returns, among other things. So we'll keep it at that. But there's some RevProcs that came out that provided relief for these type of partnerships as well. And these partnerships they're partnerships that have pretty much other partnerships as partners, or I believe there's some other qualifications that's escaping me right now, but it's you're not subject to the BBA rules if you're an individual, corporation, S corp that has less than 100 partners, and I believe in a state. If all these are the only types of partners you have in your partnership, you're not subject to these rules. And why that matters is if you are subject to the new regime, the BBA, if you are a BBA partnership, you generally are not allowed to file an amended return. But there was reliefs that was passed, and so you can file an amended return for 2018 and 2019 if the 2019 return was filed before the RevProc was out, and you have until September 30th to file those. But I think I go into more detail on a different slide. I'm getting a little ahead of myself here, but anyways, just to keep in mind, if partners of partnerships are going to have to, if you amend a partnership return, the partners of partnerships are going to have to file amended K1s. And depending on how many flow-through entities and how many tier levels you have, it can be a burdensome proposition to file all those amended returns. And all taxpayers have until 10/15/2021 to file those 2018, 2019, 2020 tax returns. And the statute of limitations for filing amended returns still applies. So if you're getting, you need to be aware of when the 2018 return was filed. And then I think we're good there. And so that's amended returns. Another option, to me, I think this is an easier option, is the option to file Form 3115. And just like the amended returns, taxpayers, including partnerships, can file 3115s. A 3115 is it's application for change in a accounting method. And it applies to, you can do this for changing the depreciation, the class life from 39 to 15 year for qualified improvement property. It's for making late elections. There's one little caveat where you can't revoke a previously made election to depreciate under ADS. You can only do that by amending a return. But that's probably a little bit too much in the weeds for this presentation. Similar, it applies to 2018, 2019, 2020 taxable years. And usually, generally must be filed after the succeeding year after the return was filed. So after qualified improvement property was placed in service. And so may be included. Yes, and so, so we can only do this for returns that were filed on or after 4/17/2020 and before the 10/15/21 deadline. That's similar to amended partnerships. This does not apply, like the amended returns, this does not apply to electing out of the business interest expense rules. And like I said, there's a whole process to that. And so the date, and so we'll go into this a little bit further, but then, and kind of usually you have to, I believe you have to wait 2 years before you can file a 3115 or to change from method to permissible method. But this RepRoc 2025 provided an exception to that. So they just provided more relief for taxpayers. This is a little bit too much. And then I threw this slide on here for all my tax preparers out there. These are kind of the sections you're gonna fill out. Here at Lane Gorman, we try to be as efficient as possible. So if we can standardize something, we will. And that's what we have here is, these are all the, I'm not going to pull up a 3115. I'll save everyone that. But there's a reduced refiling. So the reason it's easier to file 3115 over amending a return, especially if you're dealing with flow-through entities, there's a reduced filing requirement. So when you file a 3115, you can pretty much say if I say I have a 2019 tax return, I haven't filed it yet. I'm going to just go ahead and change. I don't do anything special to use 15-year property for qualified improvement property since I haven't filed the return yet. But say in 2018, we use 39-year for the qualified improvement property. If I want, filing a 3115 will just allow me to true up that depreciation. So it'll allow me to take the additional depreciation I could have had on my current year 2019 return, as opposed to having to go back to 2018, amend several returns. It could be an easier process, but there's also, you have to just look into everyone's own situation. But anyways, I think this is the last one that has all these numbers on. I'm not even gonna go into what all these are, but all right. Yeah, so I got a little ahead of myself earlier when I was talking about BBA partnerships, but you know, as I said, important date for those partnerships, and I'd say most of the partnerships that we deal with at the firm are BBA partnerships. So if you want to fix a 2018 or 2019 return by amending it, you have until September 30th of this year to fix those returns. Otherwise, there's still another way to fix it, but it's much more cumbersome. It's much more of a pain. And what BBA partnerships have to file is what's called an administrative adjustment request. And I'm not going to go into what all that entails, but it's essentially, it pushes out, there's a bit of a delay when it comes to getting that. So you don't get the immediate relief that you otherwise would if you were to file a 3115 or amended return. And if you're filing an amended return for a BBA partnership, there's some additional disclosures you have to make on that return. And you just have to put file pursuant to RevProc 2023 at the top of the amended returns and the K1s. Yeah, if generally that administrative adjustment request is kind of the last option you want to get, because Congress passed these to provide immediate relief to people suffering from what's going on out there. And so immediate relief being you get a large deduction on your return and you have to file your individual tax return to get the tax savings, but anyways, yeah, the administrative adjustment request just kind of slows that down. And so let's close this down. And so just some practical tips with this that I think I've kind of gone over, but if you've already filed a 2018, 2019 return, if you have options, you have options. You go back and file amended returns for each return, or you can go back and file an amended return for your 2019 return, and then include a 3115 on there for your 2018 return, so you can true everything up on the amended return and kind of reduce the filing requirement. Yeah, so it's you have options out there, and just so you know, if a taxpayer has already filed their 2019 return, but they filed it after the original due date, so they filed an extension, you still have the option to file a superseded return. So you don't actually have to do amended return or a 3115. You can file a superseded return. But yeah, there's just some practical tips for us. So we have options. That's what we're getting at. We got options, which is good because each taxpayer situation is going to be different. 2018 could be for one tax. It could be a high income year, and of course you want to go back into that year to get that deduction. Or if it's not, if it's inconsequential, then you can just true it up through 3115 on your 2019 return. So anyways, we got options, which is good. And so when making these decisions on, how to get that deduction, how to get that bonus depreciation, you have to think about other aspects of the tax law because there could be some unintended consequences here. And I keep bringing up, I know this is a webinar about qualified improvement property, but I probably talked just as much as about business interest expense, but it could be a huge limitation to people. And so when you're deciding whether or not to amend a return, you also need to consider if taking that additional depreciation is going to throw you into a loss position. And for limited partnerships, if you go into a loss position, it could classify you as a tax shelter for a given year. And this is an annual, it's an annual test, it's an annual classification. So you can be a tax shelter one year and not one the following year if you have enough income. But if you're trying to decide of when to amend those returns, we should take that into consideration, because last thing you want is go back, you're thrilled to get this bonus depreciation that you're so peeved that you didn't get. You go back and you amend a return all willy-nilly, and then you're slapped on a huge limitation for business interest expense that you didn't realize was going to be there. In that case, in that scenario, you'd want to do a 3115, and most likely. And so another aspect of the tax law that you also want to take into consideration is the qualified business income. And so any additional deduction you're going to get is going to reduce, or let me step back. The qualified business income deduction, it's a deduction provided. It's 20%. It's a 20% deduction on pretty much all your pass-through entities. So your Schedule E activities. And so anyways, taking more depreciation deduction is going to lower your taxable income, or it's going to lower your income from your pass-through entities. And so it's going to reduce the amount of deduction you could have had. So it's just another consideration that you have to think about. And so then this is another aspect that I haven't seen too many conversations about this, because most people just, it's better to have your money now than than wait. But a patient taxpayer, they could, if you think about it, the qualified or bonus depreciation or depreciation, it's not going anywhere. And so it's just a timing issue of when you're going to get that depreciation, whether it be all at once using 100%, or whether it be that asset depreciated over its normal class life, 15 years in this case. The qualified business income deduction is not a permanent aspect of the tax law. It's set to, I believe it's set to expire in 2025. So if you think about it, a patient taxpayer, if they want to roll the dice and expect that to leave, having more income in the long run, you could end up having more deductions if you decided not to do bonus depreciation. But I've had very few people even talk about that. So, but I just wanted to throw that out there, just because we have options out there. But yeah, but anyways, so let's go here. And so, yeah, the CARES Act, with them slipping in that qualified improvement property technical correction that no one thought was ever going to happen, because well, we just didn't think Congress was going to act, provided a huge, pretty significant relief to taxpayers, especially those who are affected by this. So it's, commercial, the real estate industry. And so, it was a huge welcome for this to be fixed. And with them to offer all these rev procs and to be able to have options to decide what we want to do. Yeah, considerable tax savings, especially if you're making large improvements, which we have many clients doing that. And then one additional thing to consider is, they also, and I'm not going to go into this at all, but they allowed the net operating losses to come in. So, corporations could have added benefit from the technical correction. An additional deduction, if the additional deduction creates a net operating loss, that loss could be carried back now. That was an aspect of the CARES Act that was passed. And that's it. We did it. Hopefully your brain doesn't feel like mush. It's very odd not talking in front of an audience and seeing everyone's happy face. But we got any questions or anything? Or
We do have a couple of questions. So do you recommend partnerships file an amended return now, or do you recommend waiting to do the adjustments on the 2020 return?
It really just depends. It just depends on each taxpayer's position. If 2018 qualified improvements weren't significant, or you have if ownership is spread out among several owners and it's kind of small ownership percentages, it may not be worth the burden of going back and the tax preparer bill may be more than you're actually going to save. I don't know if I'm supposed to say that, but anyways, you just have to evaluate each year. And so, if you had significant improvements for 2018, and you're also looking at back then you had high income, then definitely you'd want to go back and amend that return. But if it wasn't significant, then we generally just recommend truing it up in the upcoming years.
So I believe we have one more, but if anyone else has any questions, please feel free to pop those in the Q&A function and we'll get to those as well. So is there a materiality threshold you recommend?
I think generally for clients, and ownership kind of depends on this, but if you have several $100,000s of qualified improvements, then I think we generally would recommend either amending or at least doing a 3115. But if it's kind of below that 100,000 range and you don't have significant, or the taxpayer at the end of the day doesn't have significant ownership, it's not gonna be worth I don't think it's gonna be worth the trouble of amending those returns. Because say for example, if 2018 you had $100,000 qualified improvement, just say 37% tax rate, and then if you factor in the qualified business income deduction, in total you're only going to get $17,000 savings on that. So if you spread that out amongst your partners, it may not be worth doing so. So I think generally we look at several $100,000s worth of qualified improvements.
Thank you for joining us. As this situation is constantly evolving, please make sure to follow our events page for more information. Link is in the description below, along with other important links, including our social media. If you want to see more of the Lane Gorman Trubitt Summer Survival webinar series, subscribe below and hit the bell icon for notifications.